All right, just coming back to see if I need to do one more audio check 3 minutes before scheduled start. I see we have 7 attendees logged in at the time.
You are right. Hey, Tariq. Yeah, I remove sharing rights for your screen. I'm just going to give you sharing rights right now because I noticed you were sending an email.
Yep,
So let me give you
thank you.
sharing rights once again so you can flash your slides.
Yeah, much appreciated. So, I was
Okay.
actually updating some text on my book. I'm writing my second book right now,
Oh, nice. Look at you.
so it's quite
All right. I
exciting.
hope. Yeah, I hope you can tell us more about it when it's closer to completion as well.
Oh yeah, that would be awesome. A lot to talk about there. So.
Nice. Sounds good. Sounds good. Okay, so just a heads up, I'm just going to give a short introduction and then tell a little bit more about the speaker to the audience, as well as do a quick sound check with the audience. So they will have an idea of where the question box is and they can type their questions in there so we can address them towards the end of the webinar or during the session if you prefer. You have
Excellent.
the ability to look at the questions as well. Okay.
Excellent.
All right. Yeah, so we just need to sit tight for 2 more minutes and then we'll start the session.
Good.
Hi, welcome once again to our live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. And who do we have in the studio today is none other than Tariq Dennison. He's a multinational wealth manager with a passion for financial education. If the name sounds familiar, it's because Tariq has been featured on many news channels around the world, providing market insights. I saw him very recently on CNBC, and I went, hey, this is someone who is going to have in one of our webinars coming up. He runs the US registered investment advisor firm GFM Asset Management and Hong Kong licensed asset management firm GFM Group Limited. Tariq also teaches 2 Masters in Finance courses at Essex Business School in Singapore, one on fixed income and the other on alternative investments. Prior to starting his own firm, Mr. Dennison traded for Commerce Bank, Bear Stearns, and JP Morgan in New York, CIBC rather in Toronto, London, and Hong Kong, and Societe Generale in Hong Kong as well. Tariq earned his Masters in Financial Engineering from the University of California at Berkeley and is a full member of the Society of Trust and Estate Practitioners. Tariq, incidentally, has also written a book, which he's going to tell you about in a very short while. Members of the audience, before we kick things off and hand the reins over to Tariq, can I just do a quick sound check? If you can hear me loud and clear, just go on down to the question box and type yes if you can hear me. The question box is located on the control panel. It's somewhere close to the bottom. Just type yes if you can hear me. All right, thank you so much, Tariq. If you're all set to go, I'll hand the reins over to you right now. Tariq, please.
Okay, thank you very much. Good. Okay, I'm just starting to see some of the yes answers in the question panel. So just in case I can't see the questions, I may ask for help reading them out at the end. Just so that you know, I will wait until the end before answering any of the questions, just because I want to make sure we get through all of this material in a timely manner. And very often when I've done these, I often find that a question on slide 7 will be answered in slide 13. So thank you very much for that very kind introduction. As mentioned, we're going to be talking today about crypto, a very timely and exciting topic for those of you who are attending this, I'm sure. I'm going to be giving my quick rundown of what's happened so far and really what are the main things to look out for as a crypto market outlook for 2023. A big part of that really is going to be choice of instrument. So it's really going to be one of the questions we'll deal with is, does it make sense to get a cold wallet and trade physical crypto and store it offline in cold storage? If you're really a short-term trader, does it make more sense, say, to use futures contracts or other instruments? Those will be things that we will be addressing today. So before I continue, a very important disclaimer from me, And for any of you who may not have seen me on CNBC, read my book, heard me in any other locations, a very brief introduction to me. My name is Tariq Dennison. I run 3 wealth management firms, GFM Asset Management in the US, GFM Group in Hong Kong, and I am right now in Switzerland, currently in the process of setting up a Swiss licensed advisor entity here. Next year I will be celebrating 1/4 century of experience in the markets, so 25 years since 1998. Mentioned from a list of firms that Tria's already listed for you, so I won't say them here. I have a master's in financial engineering from UC Berkeley, and the business school I teach at in Singapore is over by One North, so sandwiched between NTU alumni and NUS. Part of the alternative assets course, as you might imagine, does cover crypto. It is an area that I'm following and quite interested in, although you may get the impression that I'm a crypto skeptic, depending on how you listen to my presentation today. If you want to follow me on Seeking Alpha, the name of my Seeking Alpha channel is called The Expat Portfolio, and I'm in the process of rebranding my YouTube channel and other channels that way as well. I have so far only written 1 book titled Invest Outside the Box, which you can see right below my profile photo. And as mentioned, I am in the process of writing my 2nd book right now titled 10 Ways to Invest, basically a comparison of 10 different investment philosophies in practice. Part of what I'm going to do there too is talking about how does, for example, an index investor versus a value investor view something like crypto. All of that will be something that you'll see my views on reflected today. So what are we going to talk about today? Really, obviously, crypto is a large space, but I'm going to be focusing on the 2 biggest ones, namely Bitcoin and Ether. So as with many of my presentations, I'm going to start by talking about the fundamentals, what are Bitcoin and Ether, and then the second part is going to be about futures and strategies. So the very, very basics, and again, this is always going to be a challenge whenever I present to a broad audience. Some of you are going to be relatively new to crypto and really want to make sure that you understand the fundamentals of what crypto is, why it moves up and down so much, what are fair ways of trying to value it, what are the different platforms I can trade it on. Some of you who are going to be more advanced and already understand a lot of those things may just see that as review, and you're going to be more interested in
Hey, Tariq.
has to do with Bitcoin mining and the
Tariq.
cost. Yep.
Hey, I think we lost your sound for the last 30 seconds. Maybe you can just recap.
Oh dear, no problem. Well, hopefully you can hear
Uh,
me again. So
yeah,
in
you're good
terms
now. Thanks.
of Bitcoin fundamentals, one of the first things I will really be talking about as a denominator is mining costs. So Bitcoin mining and what the proof of work algorithm really means for Bitcoin specifically. Related to mining costs is the concept of halving times, which is really built into the Bitcoin algorithm, and of course has a significant impact on the supply side of Bitcoin. So After we talk about the supply side, we then, of course, need to talk about the demand side. And there are several data sources we can look at for that. I'll provide you some renewed data points on that as well. We then want to compare Bitcoin with Ether, Ether being the token for the Ethereum platform, which really in many ways is quite different than Bitcoin. And the fundamental drivers for it have less to do with mining and more to do with the demand for decentralized applications, or dApps, in the Ethereum ecosystem. One of the big changes this year was the Ethereum 2.0 merge, basically the shift from proof of work to proof of stake. We're going to take a little bit of a look at what impact that has and why that gives Ethereum quite different fundamentals than Bitcoin, quite significant for the 2023 outlook. Then when we move on to the actionable strategies, I'm going to be talking a little bit about the difference between trading in the spot markets versus trading in the futures markets. What are the advantages of doing one versus the other? I'm then going to be doing a spotlight. I'm going to be focusing very specifically on micro Bitcoin futures, micro Ether futures, and also micro options contracts. So these will be three instruments that you can trade on a regulated exchange, which have lots of advantages and a few disadvantages relative to trading the physical currency, really again, depending on what your objective is. In all of this, I'm going to provide a few sample trades to give you an idea of what your trading strategy might look like if you've got a view that prices are going to go up or down. So, as mentioned earlier, I am really just focusing on the top two cryptos in this specific presentation, Bitcoin and Ether. Combined, these have a market cap of just under $500 billion as of earlier this month. My source for this is a site called coinmarketcap.com, which any of you who I think have been looking at this for a while are probably already familiar with. But as you will see, Bitcoin and Ether are not the only cryptocurrencies out there. There are several other ones that you've probably heard of. You've probably heard of Binance. You've probably heard of Tether. You've probably heard of Dogecoin. And you can very, very quickly get lost in all of these. I would say start by understanding Bitcoin and Ethereum, because the concepts to understand those two will really cover 90% of what you need to decide to say, well, is Dogecoin actually worth a second look, or is it a waste of time, or how does Cardano compare to Ethereum? Start with these top two and make sure that everything I say today is clear before moving on to the other ones. That's my view there. You may also want to be clear that some of these other coins depend on Ethereum, or some may even be dependent on Bitcoin. So for example, Ethereum is the center for what you might call the decentralized finance, or DeFi ecosystem. And so DAI, the token right at the bottom of this, which is why I went down to number 13, not just number 10, is a stable coin pegged to the US dollar based entirely on Ethereum smart contracts. So in order to trade DAI, you are basically trading on the Ethereum blockchain. And so understanding Ethereum is key to understanding DAI and understanding DeFi more generally. So that's why you want to pay attention not just to the top two, but to other coins which are based on Ethereum as well. One of the things that are obviously big in the news lately is FTX, and all these customers that have lost their money, with FTX. I'm shaking my head at this. I obviously hope none of you listening to this lost a significant amount of money with FTX, but my answer always was FTX was never supposed to be your custodian. I mean, it's one thing obviously to have a brokerage account where you buy shares of stock and keep it there, because you can't really keep shares of stock in your house. But if you buy Ether tokens, you should probably take it off the exchange, move it onto a hard wallet, and keep that hard wallet somewhere safe with some backups. That is my very, very strong view of one of the differences between crypto and physical asset or financial assets like stocks or bonds. But what I'm going to compare that token to, the self-custody cold wallet solution in blue for cold storage, versus the synthetic approach via futures, is that one is more if you're going to be really storing it away for nuclear war, whereas the synthetic approach is really if you're trading it because you see Bitcoin is at 17,000 and you want to capture the move from 17,000 to 19,000. Those are two very, very different strategies, and both of these solutions will protect you from an FTX type solution because you're not relying on unregulated exchange to keep your coins. So the self-custody solution basically says that you can use an exchange like an FTX or a Coinbase or a Binance to buy your coins, but then you immediately transfer them off the exchange to a cold wallet. And you can get a Ledger or a Trezor. There are a number of different cold wallet solutions, but the idea is you are not keeping your coins on the exchange. Now, obviously, what does this mean? It means you're going to have to know how a cold wallet works. You're going to need to know how to do backups. You're going to need to make sure you don't lose your keys. But what you're doing is you are replacing a counterparty risk with a technology risk. And like I say, the counterparty and technology risk can be minimized, but not completely eliminated. So if you buy coins on an exchange, there is that brief period of time, maybe 10 or 15 minutes even, when if the exchange goes bust during that period of time, you're still at risk because you've sent your money from the bank to the exchange, you've converted it, you're going to need to be able to get your coins out in time. I found this situation with Mt. Gox. I found that there was an arbitrage at that time between ANX in Hong Kong and Mt. Gox, which is over in Japan. I sent my Bitcoins over to Mt. Gox. I converted it, and then I tried to get my money out. I couldn't. So eventually I gave up. I converted it back to Bitcoin, sent the Bitcoin back out. There is a counterparty risk that you're dealing with anytime you're sending real money to an exchange. So that's one thing that you're dealing with anytime that you're trading physical coin. The way to minimize it over any period of time is to minimize the amount of time you have any coins on an exchange. Move them off to a hard wallet, do all the security precautions there, and most importantly, do not lose your coins. I call this the most powerful solution if you really know what you're doing and you really care more about your technology security than price fluctuations. In other words, self-custody is not a solution if you're trading, from minute to minute, from 18,000 to 17,000 to 16,000 back to 19,000. But it is if, let's say, you want to buy 10 Bitcoins and then just keep them away, for a long, cold winter for whatever reason. So that's the self-custody approach. What about the futures approach? This is the approach that I'm going to be talking a lot about more. If all you're really doing is you are trying to trade Bitcoin and Ether because you want to profit from price moves, do you really need physical coins? Do you really need to deal with a Binance or an FTX or a Coinbase? The better solution might be just to trade futures contracts. Futures contracts means you don't ever actually take possession of coins, and coins are never actually sitting in an account on any exchange. Rather, you put a little bit of margin in your Phillip account. You buy a futures contract in your Phillip account, and then when the futures contract moves one way, you make money, moves another way, you lose money. You are basically participating in price moves on a highly regulated exchange, in a regulated brokerage account, without all of the risks that come with a physical exchange like an FTX or a Binance. So that's really what you're doing here is, do you want the price moves or do you want the physical? Another advantage with this approach is that the pricing is very, very competitive. When you are trading Bitcoin on the CME or Ether, you are really getting institutional grade pricing. Like if a large pension fund is going to be trading Bitcoin, they're going to be trading at a price closer to where CME is trading it than where Binance is trading it. So you've got competitive pricing, you've got no custody issue, and your cash there, because you're not actually spending your cash on Bitcoin, is going to earn whatever interest Phillip pays you on your cash. So what I would say is if all you want to do is trade price moves, the futures is actually a much simpler way to do it. If you want to trade long, and especially if you want to trade short, if you want to make money from Bitcoin going down, it's much easier to sell one futures contract than to do any other, DeFi, borrowing, any other trade that we might be discussing on the DeFi approach. I would also say, though, this is also if you do not care about the tech, you do not want to learn about cold wallets or multi-sig, but the trade-off there is you're going to have to roll your futures contracts because futures contracts expire every 3 months. So those are the two big ways of trading it. Now let's get into the two main ones, Bitcoin and Ether. Let's start with Bitcoin. So first of all, what is Bitcoin? I've given this presentation earlier this year, but for any of you who may not have heard it, I've provided a link to a YouTube video below. This is from a YouTube channel called 3 Blue 1 Brown, which I highly, highly, highly recommend for math concepts, and especially if you have teenage kids who need to learn math a little bit better, it's really, really good for that. And so Grant, the founder of the channel, did an excellent video, better than I could have done, explaining what a Bitcoin is and what does it mean to own a Bitcoin. Quite simply, it's a ledger. It is a long list maintained by a bunch of computers that basically says who owns which Bitcoin address holds which Bitcoin. It is protected by cryptography and nothing else. So in other words, there is no bank, no HSBC, no one else telling you that you own this Bitcoin or Alice owns this Bitcoin. Rather, it's whatever the computer says, that this address owns 1 Bitcoin, the other address owns 1.5 Bitcoins. And the chain of transactions, the reason it's called a blockchain is because every link in the chain, every current state of Alice has 1 Bitcoin, Bob has 2 Bitcoins, is based on the previous link in the chain. So this is done by a set of hashes and digital signatures, which are practically impossible to hack. No computer in the world would be able to go back and change that chain of events within a million years of computing time. And in order to change the ledger, you need to expend a large amount of computing power. That is this proof of work that you see at the bottom of every single block in the blockchain. So short answer is I recommend you go and see this video because he explains better than I do what this chain of basically cryptographic ledger items does in order to make sure that if you buy a Bitcoin, the only way that you can transfer that Bitcoin to someone else is to actually sign a transaction, which only you with your private keys would be able to do, and that only this ledger would be able to make sure it's sent to whoever you're sending it to, and that that person would have it secure, and they would know that no matter who you are, it's there in the ledger, and they have that Bitcoin good and secure. So quite simply, it is money transferred purely by work of computing power and numbers, and and backed by the computing power. No bank, no government, no centralized authority. How is it that decentralization actually works? Well, at any given time, any one of us can take our computer, turn it on, try to do some Bitcoin mining. But the only way to actually add a block to the Bitcoin blockchain is to basically guess a number that has a certain number of zeros in front of it. In order to do that, it requires an enormous amount of computing power. And this is measured in terahashes, basically the number of billions of guesses that you can make in a single second. So as you can imagine, only computers with a very high hash rate, be able to guess many, many billions of these every second, are going to win that race and be able to confirm that transaction and add the next block to the blockchain. And you can say, well, okay, what's to prevent someone from a really, really powerful computer from doing a few fake blocks in a row? Well, in theory, you could if you had 51% of the computing power on the entire network. In practice, nobody, not even the NSA, has that because you put more computers on, someone else is going to put more computers on. Whatever is the longest chain in the blockchain is the one that we're all going to believe. So in order for you to take over the Bitcoin network, you are going to need to consistently put out 51% or more of the mining computer power on the entire network. And that's what no one has been able to do. And that's basically the arms race that keeps the Bitcoin network in check. Once again, the YouTube video, I think, does a much better job explaining it than I've been able to do in these few seconds. I highly recommend a watch if you haven't seen it already. So earlier I mentioned that mining, that proof of work algorithm. What exactly is that? That's the guessing part. That is the thousands or of terahashes, billions and billions of numbers guessed in order to guess. So every block, what is a block? A block is a number of transactions where we say, okay, in this particular block, we're going to say that Alice pays Bob 20, Bob pays Charlie 10, Charlie pays you 50, you pay Alice 30. All of these transactions are included in a block, but in order for that to be in the ledger, this is the same thing as, say, a banker saying that you have sent your friend $10. In order for that to be put in the ledger, it needs to be signed with something called a proof of work. So that is that green number at the bottom, which just in this example is 899746. Whoever guesses that number is going to run it through the hash algorithm and come up with a hash that begins with a certain number of zeros. That math problem, as I mentioned, is the problem that's really, really difficult, that requires guessing billions, if not trillions of numbers until you finally get the one that meets that. Now, the bonus for doing that is if you are the one that guesses that number, you get to assign yourself a mining reward of, in this case, 10 LD or 10 Bitcoins, whatever the given mining reward is for the algorithm of the time. That mining reward halves over time. So at specific numbers of blocks, the mining reward decreases, and that in theory increases the cost of mining, which puts a floor in theory on what the Bitcoin price would be. So again, I've described it really, really quickly, but that in a nutshell is what mining is. You are racing to be the one to put in this proof of work, because if you do, you get to reward yourself whatever the current mining reward is in that block, and that is going to be in your wallet, until you send it to somebody else. So earlier I mentioned the thing about halving times and mining rewards, and what does this really mean for Bitcoin as a currency? Well, what it means is the money supply is fixed by definition. So every single block gives a certain amount of mining rewards. Originally, it was 50 Bitcoins per block, and then it was 25, and then it was 12 and a half, and then 6.25, and we'll see what that schedule is. But what it means is that the number of Bitcoin grows over time, but the rate at which it grows slows down until eventually all of the Bitcoin in the world will have been fully mined by about the year 2140. What that means is that the actual inflation rate, the increase in the money supply, is severely limited, and it's limited by algorithm. So unlike, say, the Federal Reserve, which is able to just simply print more dollars and cause inflation, the amount of Bitcoin is never going to increase faster than this chart shows you. So that gives you the supply side. The supply is limited. My bear case is just because the supply is limited doesn't mean the demand will be there to push the price up. But for those who think, you call them Bitcoin maximalists, those that believe that this limited supply of Bitcoin makes it the most sound money there is, will often point to a chart like this and say, the Fed can print more dollars, but you cannot print more Bitcoins because the algorithm has limited the mining rewards. So as I mentioned earlier, that chart, which tapers off and shows a leveling off of the number of Bitcoin, will be contrasted by, say, the money supply of the US dollar. And there are many ways of measuring it. This is a measure called M3, which counts not just bank deposits and dollar bills, but also time deposits and other, longer term bank deposits at your bank. You'll see how much this increased in the global financial crisis, but especially during COVID. How many trillions of dollars the US Federal Reserve basically printed out of thin air because it wanted to stimulate the US economy. If you had US dollars sitting in your bank account over the past year, you've basically seen inflation eat away 9% of it. Now, whether or not Bitcoin is actually a better store of value and Bitcoin can fall over 50% over the same period of time, I'll leave that up to you. But again, people will compare the supply of US dollars versus the supply of Bitcoin to argue one is more sound money than the other. So earlier I mentioned halving times. So those are events which basically define when that mining reward, so when the reward for being the one who's the first to guess correctly what gives you that right hash starting with the right number of zeros, it by design will decrease after a certain number of blocks. So the first 210,000 blocks were awarded 50 Bitcoins each in order to mine those blocks. And in hindsight, that looked wonderful. At that time, of course, it was only like $100 per Bitcoin, but it was still a pretty good reward if you put in enough computing power to get them. At block number 210,000, and that happened on the 28th of November 2012, the Bitcoin reward was reduced to 25. And then in 2016, on block number 420,000, it was reduced to 12.5. And then most recently in 2020, at block 630,000, it was reduced to 6.25. So this very clearly shows you what that progression is, what the number of Bitcoins being produced with every single block is so far. And the next one shows you what the next ones are scheduled to be. Now, the reason that we don't have the exact date for the future ones is that the Bitcoin halvings occur at certain block numbers, not on certain dates. If for whatever reason it goes from taking 10 minutes per block to 8 minutes per block or 12 minutes per block, because of the amount of computing power involved, that will push the exact date of the halving, forward or backwards by a few days. But roughly, based on our estimate, block number 840,000 will occur around the year 2024. And at that time, the block reward will go from 6.25 to 3.125 Bitcoin per block. And then in 2028, it's scheduled to go even further, down to 1.56, and then 2032 down to less than 1 Bitcoin per block. So this, I've provided the source for this, a site called zenledger.io. There are many, many other sources you can look for this. This is something that many Bitcoin bulls will argue is a bull case for Bitcoin, because the amount of computing power required to mine a block is not going to go down as more and more computers enter. But on the other hand, the reward that you get for expending thousands of dollars of computing power is going to get cut in half. So that, in theory, is going to push up the cost of production. If the demand remains the same, that would push the price higher. Again, that huge, huge, huge variable, I believe, is demand. Just because the supply is limited doesn't mean that the demand will be there. Now, one other way of looking at this sometimes is charting Bitcoin mining costs versus prices. So mining costs generally are, what is the cost of mining a block? So in other words, you take electricity costs, you take however many hashes you need in order to guess, the given number, and that gives you your mining cost. Now, if mining cost is $20,000 a Bitcoin and Bitcoin is selling at 40,000, it's clearly very, very profitable to be a Bitcoin miner, especially if you're in a place where electricity is cheap. On the other hand, what you can see right now, what makes some people somewhat bullish about it, is that the price of Bitcoin has actually fallen below the average mining cost. Now, it's not to say that all Bitcoin miners are losing money. Those where mining is very, very cheap, those that have better processors, can probably still make profits mining. But obviously, if it costs you $20,000 to mine a Bitcoin that you can sell for 17,000, a lot of miners are probably just going to turn off their computers for a while and wait. I'll let you figure you another site you can look at for some kind of fundamental measure of what the price of Bitcoin, might be fair value wise. I think if you're really serious about Bitcoin, you really need to dive a little bit deeper into block statistics, basically into how many transactions are actually happening, what is the cost of those transactions. I've mentioned that in order to, those that mine a transaction can award themselves that certain Bitcoin reward, which halves over time. But when you send a Bitcoin, you can also add something called like an extra reward. You can add a transaction fee to encourage the Bitcoin miner to include your transaction in that specific block. And especially when there's a lot of demand to get transactions in, there's a limited number of transactions that can be per block. People will bid up those transaction costs because they want their transactions to be included, and they basically want to make sure the miners get paid for that as well, so that they're included. This will show you what some of those statistics are. So, for example, you say, what was the average transaction value of the transactions over the past 24 hours? So, according to this one, there were 270,000 transactions over the past 24 hours. That's about 11,000 per hour. Those of you who know how many Visa does, that's really nothing still, but that gives you an idea of what the actual activity is. The average transaction value is 1.46 Bitcoin, so the average of all of those. That clearly tells you that it's probably, those were probably not used by, pancakes or other things. But remember, that's the difference between the average and the median. Lots and lots of statistics here you can then go drill down onto. But they had some
Hey,
cost to
hey
physically
Tariq,
send those. Yep,
I'm so sorry,
yep.
but we lost you for like 10 seconds.
Okay. Well, all right. So sorry, that was just 10 seconds again. The main thing that I'm really highlighting here is that most of what I'm talking about is the value of looking at different statistics here on a site like this. And this one is from BitInfo Charts. This one will provide you not only information on transaction volume and transaction costs, it will also give you things that you hear about, wealth distribution in Bitcoin land. So for example, you hear that the top 10,000 addresses have 56.6% of all the Bitcoin in the world. And you can decide that in terms of, how manipulated the market is. I'll leave all of those up to you, but I encourage you to go look at sites like this to understand what's going on in Bitcoin transactions. Drilling down onto specific blocks. So earlier I kept talking about blocks. What do these blocks look like? So over here, block number 766,129, that's called the height of the block. It's basically the number of blocks, that have been in that chain, had transactions totaling 20,374 Bitcoins, and you see how far that goes down. The miner was awarded 6.25 Bitcoins for that transaction. You can see the timestamp, you can see all sorts of other information there. And then on the right side of this slide, I've also included some information on who the richest addresses are. Now, an address is a public key. I can put my Bitcoin address like on my website, or I can give it to you on my business card, and you won't be able to take Bitcoins out of that, because in order to figure out my private keys from that public key, you'll need an enormous amount of computing power. But on the other hand, with that address, you can first of all verify my balance, and of course you can send money to that address. So unlike with my bank account, you can't see what's in my bank account, but if I show you my address, you can look on the blockchain and you can see how many Bitcoins are actually in that specific address. So you can see the top 5 addresses each have over 100,000 Bitcoins each in them. Just to give you an idea of what the distribution of value is on the Bitcoin blockchain. So that was Bitcoin. Really, I just threw a lot of information at you, hopefully encouraging you to do some research there. Now let's talk about Ether. Ether, as you might guess, has lots of similar statistics to Bitcoin because it also runs on a blockchain. There are a few differences between the Ethereum blockchain and the Bitcoin blockchain, as we'll see in a bit. But what you can see here is that the number of transactions on the Ethereum blockchain is significantly higher. There's a few reasons for that, namely that Ethereum powers DeFi and it powers other decentralized applications and smart contracts. That's something that you don't see in Bitcoin, but that's why you have a higher rate. One of the reasons that we all got excited about the transfer from proof of work to proof of stake is that having all of those computers guessing numbers and doing billions and billions of calculations is very, very energy intensive. Proof of stake, in theory, should be a lot more energy efficient and should, in theory, bring down the cost of transactions. What you can see here is that the average fee per transaction is still around 2.4%. So we're still not at really, really cheap transactions yet, but these are sites worth watching in order to see how Ethereum fundamentals are doing over time. So again, what makes Ethereum so different than Bitcoin? Ethereum powers an ecosystem of all sorts of different applications. Now, these range from stable coins, where basically I can send something pegged to US dollars, but based on an Ethereum transaction. With that, I can do decentralized lending. So let's say, for example, I want to borrow 10 Ether and sell it short. I can do that on a platform like Aave, where basically I can give you 20,000 DAI as collateral, and then you lend me 10 Ether tokens, and then I can sell them short, and then I can buy them back, and I can repay that with collateral. I can also do, if I don't want to use, say, an FTX or a Coinbase, I can do all of my trades on decentralized exchanges like a Uniswap or PancakeSwap. There are many, many different applications that have been written entirely in code. They're not owned by any company. They're not, run in any one place. It's entirely up to the software, and they're run on soft contracts. Those smart contracts are powered by Ether tokens, or you basically pay for the execution with Ether tokens. So how does a smart contract basically work? So let's say, for example, we've got two counterparties here. Here, one is called the maker, one is called the taker. The smart contract can, for example, define a loan. It can say, I will lend you, 20,000 DAI against 10 Ether tokens, or I will exchange, do an exchange with you, or I want to bet with you who's going to win the World Cup. And based on whoever wins the World Cup, you're going to win 1 Ether token. Whatever that smart contract might be, it's a piece of code that sits there. You or I cannot manipulate it or change the execution. Whenever that code executes, it will either send you the Ether token or me the Ether token based on whatever the code says. So that contract, that code enters the order book, and it is executed on the blockchain the exact same way that, say, sending a Bitcoin is entered into a block on the blockchain. Executing those smart contracts is paid for in what are called gas fees. So the one other thing you need to keep in mind, different than in Bitcoin, is that there's a separate currency in a way called gas, and you pay for that gas with Ether tokens. This is why I often say that Ethereum or Ether is actually a lot more like crude oil, whereas Bitcoin is like gold. You use crude oil to fuel your car. Now, different cars will use a different amount of gas or a different amount of fuel or different amount of petrol, the same way that a really badly written smart contract may use a lot more gas than an efficiently written smart contract. But either way, the reason you buy Ether tokens is to execute smart contracts at the end of the day. From a supply point of view, Ether has a different trajectory than Bitcoin. So Bitcoin has a very well-defined path for how many Bitcoins are going to be awarded with each block. Ether started off as a more inflationary token, but since a few changes have occurred over the past year, Ether is actually on the path to becoming a more deflationary token. All of this happens really within the software and the merges and these different changes you see. I'm not really an expert on all of this, but I look at sites like the one that I provided you here from Statista showing that basically since earlier this year, the supply of Ether has remained flat, whereas before that it was growing. Some of the upgrades that you'll hear a lot about, the main one is the middle one, which I've highlighted, which is the merge. That was the shift from proof of work to proof of stake. That means that it no longer depends on enormous amount of computing power to add a block to the Ethereum blockchain. Rather, now what you can do is you can stake 32 Ether in something called a staking pool. And what that means is you say, I will verify this block, a validator instead of a miner. And if anyone challenges you, your stake can get slashed. But otherwise, what this does is it requires you to put a stake to basically verify that you're honest. Others will watch you to challenge you and possibly slash your stake if you're wrong. But in general, what staking requires is that you put up the 32 Ether and that you make sure your node is available to be there and verify, validate those transactions as required. The next major upgrade that we're looking for in Ethereum is something called sharding. And sharding will basically allow the chain to be divided so that it can be executed much more efficiently, kind of like parallel processing. That's going to make it, I think, again, quite a bit more efficient than the Bitcoin ecosystem in that way. This is another diagram, just again, giving you an idea of proof of work versus proof of stake. Some people say proof of work is more purely meritocratic because anyone can take computers and then be much more innovative with how they generate their energy to try and solve the problem. Whereas proof of stake, all you really need is you need a good working computer and 32 Ether on it in order to validate transactions. Proof of stake in theory has more risk of centralization, whereas proof of work, anyone with a computer can plug in and do that. But I will leave this to you as reading and homework assignment to decide which one you think is better or more efficient. What about their price moves so far? I've really looked a lot of different places to try and find a good chart, but this is the best one I was able to produce on a site called Koifin. Over the past 5 years, if you chart them on a log scale, it probably won't surprise many of you that Bitcoin and Ether have largely moved up and down together. So that is when Bitcoin goes down 5%, Ether goes up or down about 5% too. Yeah, there are times where one goes up or down a little bit more than another, but crypto, like stocks or like other things, has largely moved up and down together as a block. So if over a period of time, you've got a view that one is going to outperform the other, you can do a pair trade using the futures contracts we're going to be talking about. But this is something to keep in mind just purely from a risk management point of view. So summary, what are some differences between Bitcoin and Ether? Bitcoin, as mentioned, is a pure proof of work blockchain. No smart contracts, no staking, nothing fancy, just raw computing power to verify each block of transactions, who sends Bitcoin to whom. There have been a few major forks so far. The two main ones that you'll see on the list are BCH, which stands for Bitcoin Cash, and the other one is BSV, which is Bitcoin Satoshi's Vision. These are basically differences in opinion on whether the block is there going to be demand to it. So the
Hey,
example, the
sorry,
analogy,
We
yep,
lost you for 1 minute maybe. Maybe just
one whole
recap what
minute.
you.
Oh
Yeah.
dear. Okay, so
We stopped at Bitcoin Satoshi's vision.
okay, well, that wasn't a whole minute, so that's good. Basically, what I would suggest is on the forks, if you're interested in the forks, go read up on Bitcoin Cash and Bitcoin Satoshi's Vision. But bottom line, Bitcoin is really scarcity as a service. The value is solely based on the demand for a fixed slice of what is a fixed supply of Bitcoin. The other variable on the other side, of course, is how much demand will be for that. Same exact thing as we've seen for gold. Over the past 10 years, there's been inflation, but gold prices now are where they were 10 years ago. So keep that in mind when making your case for Bitcoin. Ether, on the other hand, is all about smart contracts, all about the ecosystem for decentralized applications. And you want to look at that first before you think about it really as a store of value. The transition from proof of work to proof of stake is what should make those smart contracts more efficient. The main fork from Ether was something called Ethereum Classic. This was one that happened a few years ago when there was a dispute about whether a fraudulent transaction could be reversed by the Ethereum community. The main Ether chain said yes, the Ethereum Classic chain said no, and you can see from the path of the two which one has been more popular. But there's a big difference between a fork and what are called ERC20 tokens. You can go and create your own ERC20 token, your own, Tariq coin, which is based on Ethereum, runs on the Ethereum blockchain, but will have your own code, your own sets of rules for what that token will do. DAI is an ERC20 token, Uniswap is an ERC20 token. It's just a specification for how you write the smart contract that issues a given token. The value is based on what is the cost of executing smart contracts. The analogy there, as I said, is it's like crude oil or like gas. Basically, what is the cost of buying the fuel needed to run this software on the ecosystem? So now let's talk about trading these Bitcoin and Ether using futures contracts. So first of all, just brief recap for any of you who are new to futures. How do futures contracts work? Basically, you're going to need cash, or you're going to need margin in a margin account. And with that, you can buy a futures contract. So in this case, let's say, for example, you have $2,000 in your margin account. I've just double checked what the maintenance margin is. And with that, you can buy, let's say, one futures contract representing zero point 0.1 Bitcoins at, let's say, a price of 17,000. Now, if you were right, so you wanted to basically have a view that Bitcoin was going to go up. Oh, sorry, I misspoke here. This particular trade, you would sell one contract if you expect Bitcoin to go down. So in this case, let's say for whatever reason you hold Bitcoin, you want to hedge it, or maybe you think Bitcoin is going to go down to 15,000. You sell one contract, 0.1 Bitcoins per contract at 17,000. If you were wrong and Bitcoin goes up, then you lose $500. So what that is it's 0.1 Bitcoins times $5,000 per Bitcoin. So that's $500 loss. And what that does is that gets taken out of your margin balance. So you can sell a contract just as easily as you buy it. That's a way to make money if the price goes down. But if the price goes up, then the price rise gets taken out of your account. Now, by contrast, if the next day you're proven right, it goes up and you lose $500, but then it goes down to $12,000 as you expected, the difference between 12,000 and 22,000 gets put back into your account, $1,000, and now your margin balance is $2,500. So this is my introduction to futures contracts slide that I put in many of my futures presentations. Please do make sure you have mastered this slide before you trade futures. If you've traded futures and you're comfortable with it, this will all be familiar to you, but this is a must master if you're going to trade futures. The reverse, by the way, if you buy futures contract, it's of course the exact opposite. You make money if the futures goes up, you lose money if the futures goes down. If you look at the micro Bitcoin futures contracts, so here you can see the link on the CME Group website. One thing that you may notice is that later dated futures contracts actually trade now at a lower price than current futures contracts. So when I took this screenshot last week, the December contract settled at 16,825, but then the February contract was at a lower price, 16,770. This is called backwardation, and that is the opposite of contango, which is where it was a few months ago. And there's a few reasons you might say to explain this. One of the most obvious is that there could be a lot of demand for people simply wanting to sell Bitcoin short. If you have no other way of shorting Bitcoin, but you can go and sell futures, that will push down the price of the futures relative to the spot. And that means that if you buy it, you're getting a bit of a discount. If you're shorting it, you're going to have to pay whatever that borrow cost is that's priced into those futures contracts. So whenever I look at futures, one of the first things I look at is what is the difference between this next month and the month after it, and what does that tell me? Now, you may have, those of you who've traded ETFs may be familiar with the fact that there is still no ETF in the US market that holds physical Bitcoin, but there is an ETF in the US market that basically holds these futures contracts and rolls them. The first and biggest one of these is one called the ProShares Bitcoin ETF Strategy ETF, called BITO. And this one will tell you what would happen if you bought Bitcoin futures and basically rolled them every single month. Now, you should probably compare this to the Bitcoin price itself, and it won't surprise you. Bitcoin has gone down, so this strategy has gone down. Now, what has happened here? Well, until a few months ago, Bitcoin was trading in contango. So every single month that it sold one month and bought the next one, it had to pay up that difference. Now, for the next few months, when it sells December and buys January at a lower price, it's actually going to be earning a yield from doing that. So just by nature of these futures contracts, futures will let you earn more than you would have just buying Bitcoin and letting it sit. If that makes sense. It's like earning interest on your Bitcoin, if you will, and you don't even have to do any of this fancy DeFi. One of the things that does drive it a little bit is higher interest rates. Now, what does it mean if I can earn interest on my cash, but not only that, I get to buy Bitcoin futures at a discount? Well, what it effectively means is that it's like earning 7.5% interest on your Bitcoins, if that makes sense. So right now, let's look at this transaction. Let's say that you've got $1,682.50 in your Phillip margin account, and you can earn 3.9% interest, investing that in treasury bills. If you had a choice between buying the front month futures at 16,825 versus the second month at 16,775, it's effectively like getting a 0.006 extra Bitcoins, not exactly for free, but you're getting it as interest for buying the Bitcoins later. If you add that to the interest that you earn on your margin, it's like earning 7.5% interest on your Bitcoin. So if you contrast that with buying Bitcoin on an exchange and having it sit in a hard wallet, that's a clear advantage to buying it using futures. Now, in addition with Ether, I'm giving this with Bitcoin because Bitcoin is simpler. If you do this with Ether, you also need to consider staking rewards if you do staking. It's a little bit beyond the scope of this, but I've given you some things to look up. So just like with Bitcoin, Ether futures also trade in backwardation. A few months ago, they were trading in contango. So if you buy Ether futures, you get this higher yield reflected by the fact that you buy it at lower prices in later months. So what do these implied crypto rates mean? So directly, the first one is it's an imbalance due to more people wanting to sell Bitcoin futures and Ether futures. This could be for hedging. This could be just because those that want to buy Bitcoin or Ether can do it in the physical market. Those that want to short it, futures are the most efficient way to short it. Indirectly, though, it also implies that if you lend Ether or WBTC is wrapped Bitcoin, so it's Bitcoin wrapped in an Ethereum token, on a platform like Compound or Maker or Aave, you should be earning 7.5% interest. If you don't, you're better off doing it in futures. If you can earn more interest on Compound, Maker, or Aave, you should be doing DeFi and then hedging with futures, if that makes sense. So the Ethereum interest rate, as mentioned, should consider not just DeFi, but it should also consider staking rewards. So for now, don't be surprised that you might see an implied rate of 7.5% in futures and 11% or 4% in DeFi. The market is still getting developed and you don't really have efficient money markets like you do in dollars or euros. I mentioned DeFi. I just wanted to show one example of one of them. So this one is from a site called Compound. Compound has its own token, but on Compound, you can lend or borrow Ether tokens against, say, for example, USDC, which is a stable coin backed by Coinbase and another consortium. Now, what this tells you is that if you borrow USDC, you'll pay 3.1% interest, whereas if you lend USDC, you'll earn 1.48% interest. That's kind of horrible to me. Now, if it tells me maybe I want to borrow at 3.1%, go buy some treasury bills or go buy some futures and collect the difference, that's, a great trade, I think, for anyone who understands money markets, understands interest rates, and is happy managing them. Keep in mind, though, that these interest rates roll very, very frequently. So it's not like a term rate for 3 months. You got to keep this in mind with any of these DeFi platforms. So look up these top three, Compound, Maker, or Aave, if you're interested in these interest rate markets. What is a sample of an outright futures trade? So one example is that you can just buy the March 2023 futures at 16,775, as I showed you earlier. That gives you a 50% discount to December and a 220% discount to the current price on Binance, which I looked at the exact same time. It gives you an implied, quote, yield of 1 to 5% per year, plus whatever interest you earn on your cash. So that total implied interest is the interest on your cash plus the discount. But you're going to have to roll it to maintain it. So you buy the March contract, and then in February, you're going to need to sell it and buy the June contract if you want to remain long Bitcoin. So the ticker I gave you earlier, the MBTH3, March contracts end in H, September ones end in U, December ends in Z, and then the last number is the year. That's just me to keep in mind whenever you look for your futures contract. So what's the risk with doing this? Well, obviously, if the price goes down, you'll lose money. That's, just like you buy anything and the price goes down. You also, though, have the basis risk here. So here I mentioned that you buy it at a discount. There is the risk that Bitcoin price remains the same and the futures go down because it just goes deeper into backwardation. That's a risk whenever you're trading futures. So keep that in mind with any futures contract that you trade, the basis between the physical and the futures. Now, the good news is that when you trade futures, you don't really have to worry about losing your keys. You don't have to worry about a hard wallet. You don't have to worry about FTX. You're really worried more about the futures, the basis. You may be worried about Phillip going out of business, but I'll leave that to Phillip. If you ask me, I think Phillip's a much safer bet than Coinbase, but that's what you got here in terms of risk and reward. The benchmark, by the way, I've provided a link to cfbenchmarks.com. That will give you the actual BR reference rate for both Bitcoin and Ether. Let's say you want to be a little more adventurous. Let's say you've got a view that Ether is going to go up more than Bitcoin or Ether is going to fall less than Bitcoin. You want to buy Ether short Bitcoin as a spread trade. Or vice versa, but this lets you do long short, and it's just as easy as buying one future and selling the other. The exact trade in this case, now here I'm just using the December contracts. Let's say that you sell one micro Bitcoin, December at 16,775, and you buy 14 micro Ethereums at 1250. Now, why do you have to do 14? It's because of the size of the Ether contracts are much, much smaller. 14 to 1 is roughly the ratio where you'll get roughly an even value. Now, this requires that you have a relative view on Ether versus Bitcoin. You have to expect that either Ether is going to rise more than Bitcoin or it's going to fall less than Bitcoin. But you do not need to have a view of whether crypto overall is going to go up or down. That's why I like trades like this, if you've got a relative view. Once again, you've got to roll to maintain this trade. So as it approaches expiry, you're going to need to roll out of December and go to either January, February, or March. means more rolling, but that's why I use the December contract rather than the less liquid March contract. What are the risks? Well, obviously, if you buy Ether and short Bitcoin, there's the risk that Bitcoin goes up and Ether goes down, and you could lose on both legs. So that's certainly one risk because you're wrong on the direction. There's also the basis risk moving in the opposite direction. So in theory, the prices of the two could remain the same, but imagine, let's say, Bitcoin goes into contango and the backwardation of Ether goes even deeper. In theory, that could go against you. But anything having to do with futures, you can keep that in mind. Once again, though, the risks are primarily price risks, and of course, the risks of getting margin called. You are not dealing with any physical crypto, you're not dealing with DeFi, you're not dealing with any custodians here. So that's the advantage that you're dealing with. So I know I mentioned earlier that I might be getting a little bit into options trades, but I understood there was a time constraint, a number of slides constraints here. If you go into your dashboard and you go from futures to options, you will see the options contracts as well. I'd be happy to do a separate event on options if there's enough interest. But just in the interest of time, I'm almost running an hour here, and I know the audio. I see there's quite a few questions here, so I'll go ahead and get started. So first question we have here: what is my view on the exchange tokens? So CRO, BNB, and so forth. Short answer is I don't really have a strong view on them. I mean, I bought one of my kids' shares of Coinbase purely because it's a publicly listed company. I can get audited financials and so forth. But if I'm going to buy any token, I would want to know, why is that token going to give me more than I would ever put into it? I'd want to be able to evaluate it as a business. I'd want to be able to get the financials on it. And because I haven't seen the financials on it, I haven't really seen if they're out there. That's why I haven't really evaluated those yet. That's really it. Now, Binance, my whole thing with Binance is I would want to look at Binance Smart Chain. I'd want to look at what's the development of apps on that ecosystem, of the Binance USD, or more people using that than other stable coins. Those would be the things that I would look at. But I'm a fairly fundamentally oriented investor, and until I see good financials and a good reason that I would get a return other than from selling it to someone else, I'm not going to be the first one into any of these. So good question. Thank you for asking. Do you see any other questions on the panel there, Sri?
Hey Tariq, I don't have any other questions at the moment. Members of the audience, take this opportunity to ask Tariq your questions, and we will be able to address them, and you'll be better positioned to capture opportunities in the market. Tariq, maybe for the next question, you can walk us through what are the key takeaways for what you've shared with us today.
Certainly. So from a fundamental point of view, I really want to highlight the very, very different case, both bull and bear, for Bitcoin and Ether. So in the case of Bitcoin, it really does have to do with a very well-defined supply path, but the big question mark, in my view, is demand. And my biggest bear case against Bitcoin is that it basically becomes the next MySpace. Everybody thinks that it's too inefficient to use. There are other, bigger, better, shinier things out there, and nobody wants to bother expending computing power on Bitcoin anymore. That's a bear case on it. The bull case, of course, is that everybody sees it as the only reliable source of value, and it never gets cheaper to mine one. And so if you want to buy it, you're going to have to pay up for it. Ether, on the other hand, I am still surprised that we haven't seen transaction costs come down after the merge, but I do want to get a lot more excited about the development of the ecosystem. I really think that the future of Ether depends highly on more and more people using decentralized apps and participating in that ecosystem. So far, there still seems a lot more interest in speculation than in actually developing dApps. So that, I think, is the big question mark for Ether. Now, either way, the real takeaway from a trader's point of view is, if you are trading the prices of these things, futures are a very efficient way to go long or short without having to worry about any of the other issues with trading physical. On the other hand, if you want to trade physical, hopefully recent events convince you why you should not take any physical possession of why you need to take physical possession of tokens. You should not leave them on the exchange. If you just want to trade the exchange, use the futures in your Phillip account. I'll leave it up to you whether you do long, short, spread trade, options. Uh, those are the main takeaways, I think. Anything I miss?
Well, we have a couple of questions here. Do you see them,
Good.
Tariq, on your
Ah,
end?
yes. Okay. So here's one good question. With everything remaining equal, would Bitcoin halving mean a price increase? Well, yes, you're assuming that everything else remains equal. So what else are we talking about? First of all, we're talking about, say, the cost of electricity, the number of computers on the network, the amount of effort it takes to mine a coin. Um, sorry. So I'll give you an example of just about any other commodity. Let's say, for example, that the same amount of effort goes into mining gold, but all of a sudden, for whatever reason, the same amount of effort produces only half as much gold. Now, on the flip side, the exact same amount of demand comes in. The exact same number of people go into jewelry stores wanting to buy gold jewelry. If there's half as much coming out from the same amount of effort and the exact same amount of demand, in theory, it should mean a doubling of the price. Obviously, there's a question of elasticity and so on there. But the short answer to your question is yes. The tricky part of that, though, is of course all else is never equal. When Bitcoin halving occurs, you have to look at how many miners decide to go offline and sell their machines in the secondary market. How many people decide it's just too expensive to send their transactions through Bitcoin and they're going to use Ether instead. Those are all things I think you need to figure from a whole economic point of view. So that's why the answer is not quite that simple. Here's another good question. What are the tools, data platform you use to analyze crypto fundamentals? Is there any, preferably free tools, that you recommend? Really, to get started, all of the links I've provided here in this presentation, and I'm guessing that a copy of these slides will be sent out. I provided links at the bottom, which I really think are a very good starting pack of just links and reading material. Those are all public sources. They probably do deserve a little bit more due diligence. I am not a full-time crypto nerd or crypto expert to have gotten into any of the other paid services or other things, but for me, that's enough to get started. I mean, block info and so on will give you, I think, plenty of information about mining costs, transaction costs, and so on there. In terms of fundamentals, though, I still don't see enough fundamentals to find values that, so just full disclosure here, I have negligible amounts in any of these. I still view them largely as speculative. I would love to see the Ethereum ecosystem develop, but I do not really think that the fundamentals are there to really make an investment case. And in my view, they're not an investment. They are a trade, and there are many cases to be made for trading them. So even if you look at the fundamentals, the price could move in a very, very different direction in short periods of time. So you have been warned.
Are there any other questions from the audience? This is your last chance to fire away, Mr. Tariq. If not, you can send them post-webinar in our survey form, and we'll pick it up with Mr. Tariq offline, and we'll get the answers to you in our follow-up email. All right, till our next webinar, thank you for being a wonderful audience, and thank you once again for Mr. Tariq for sharing the insights about the cryptocurrency landscape.
Excellent. Thank you very much for having me.
Thanks for coming on as well, Tariq. I'll speak to you soon in our next crypto session.